Just 2 days ago, the market crashed and a lot of stocks fell by like 10 or even 20%, at least those in tech. And everyone thought this was a sector rotation because tech got hit hard. However, other sectors were still up by a little bit, for example, financials. Then yesterday came around and everything seemed to recover, and everyone was like, oh, hashtag buy the dip. However, today the story turned for worse around noontime when the market continued to tank. And a lot of these high flying tech names were down again by another 10%. So in this video, I'll be talking about everything about the stock market crash. Wait, scratch that, it's a correction, I believe. And then I'll be telling you what my outlook is. We'll look at some charts as well as discuss why this is happening right now. If you guys are new here, my name is Daniel, and here on this channel, we talk about stock market investing. And if you're interested in that type of topic, then consider subscribing to my channel. For most of this video, we're going to be jumping straight into my computer, looking over some news articles and looking at charts. So let's get right to it now. All right, so we're here on my computer and we can see first off, I've got some articles pulled up. This article is talking about what's happening, why are stocks down today, and this was posted on February 25th. So you can see that fears of inflation are weighing on the stock market, and here's what you need to know. The first part of the equation is fear, so people are specifically afraid of inflation. Investors are eyeing the $1.9 trillion stimulus package from Joe Biden, which continues to garner support from Democrats and large corporations. And some believe that it's too large and that at this point in the pandemic, all the extra money flowing into the economy will spell trouble. Investors are also worried about near zero interest rates from the Federal Reserve and growing whispers of $15 of minimum wage. Further down, the article continues on saying, as inflation rates increase, so do bond yields. We're starting to see that now, and in the past week, the 10-year Treasury yield note has climbed from 1% to 1.5%. So let's go look at the Treasury yield. So we can see here on this site here, the Treasury yield for 1 day is not available, but 5 days. We can see that just in today on Thursday, the Treasury yield rose from 1.4% all the way to 1.525%. And if we zoom out over 1 month, we can see that the Treasury yield has risen from 1% to 1.5%. Now further out, if we go a year back, basically pre-pandemic or just at the start of the pandemic, the Treasury yield was trading at around 1.2%, and today it's at 1.5%. Zooming out a bit further, we can see that at the beginning of 2020, before the pandemic, it was 1.8, and slowly we're climbing back up to those levels here. So we can see that there's a bit of a rapid rise in the US Treasury note, which is getting investors worried. Another article here recapping what happened today. Stocks traded lower and tech shares sold off as rapid rise in Treasury yields spooked equity investors. So some of you guys are sitting there thinking, what are Treasury yields? Well, here's an article explaining that. Essentially, Treasury yields are the total amount of money you earn by owning US Treasury bills, notes, bonds, or inflation-protected securities. The U.S. Department of Treasury sells them to pay for U.S. debt. How the yields usually move is that yields go down when there's a lot of demand for bonds, and yields move opposite to the direction of bond values. So how Treasury yields can actually affect the economy is probably what you're interested in. As Treasury yields rise, so do the interest rates on consumer and business loans with similar lengths. Investors like the safety and fixed return of bonds. Treasuries are the safest since they are guaranteed by the U.S. government. Other bonds are riskier. They must return higher yields in order to attract investors. To remain competitive, interest rates on other bonds and loans increase as Treasury yields rise. So basically what this means is that as the Treasury yield rises, companies who want to issue bonds are going to have to raise their rates as well. Typically, their rates are higher than the Treasury yield because they're a higher risk investment versus buying U.S. government bonds. So as this Treasury yield has risen about 0.5% in 1 month, that's a fairly significant move in the Treasury yield. We see that throughout 2020 and early 2021, the Treasury yield stayed below 1%, and it was fairly consistent. But now it's started to break out, which has got investors spooked. Because a lot of companies out there use borrowed money in order to fuel growth. But now it becomes more expensive to borrow, therefore growth will slow down. Now scrolling over to Webull, where I do a lot of my tracking of stocks, you can see here all the stocks that I've been tracking. Everything is basically blood red. There's only a few stocks up here that are in the green, and these are your more safer stocks or penny stocks that don't exactly follow the typical market trends. But everything else is pretty much blood red. Now looking at the heat map of the S&P 500, we can see across the board, everything is basically bright red, and there are not many green spots in between. Now looking at the entire US stock market, again, we can see a lot of red here as well. So today there was a big market sell-off, and honestly, I don't think we're at the bottom of the sell-off yet. And we're going to jump into why right now. Here I've pulled up a chart of the SPY and let's make a bit of sense out of this. So I'm going to be using the Fibonacci retracement because this is one of my favorite metrics or charting patterns to use to determine where good support levels are or where are good points to buy. So looking at when we had the drop in 2020, if we draw a Fibonacci retracement from the bottom to the next peak, we can see that at the 23.6% level, there was good support there and the market bounced off this line. Now if we delete that and we draw from the next point on, so we're going to draw from this bottom here up to the top, we can see that there was good support and it bounced off heavily off of the 61.8% and it hovered around the 50% mark. 61.8% in the Fibonacci retracement is typically known as a golden number. So just keep that in mind as we're going forwards. Now again, we can go from this trough to this peak here, and we can see it retraced around 78.6%. We can see that there's two candles right around here, and if I zoom in, you can see that it ended right around here on this red candle here, and it wicked down, bounced off, and went back up on this week. Now we're going to draw from the previous market low up to the latest high, and just see where we're at. So you can see we haven't even yet hit the 23.6 mark. And honestly, because we've had such a large run, I expect that we probably will drop back down to the 50 or the 61.8% mark. So right now, this is what I'm going to be looking at as one of my indicators of when to buy in. When it drops to the 50% mark, I'll probably buy in a little bit, maybe at the 38.2, but unlikely at this point. I like the 61% mark as well as the 50% mark. We can see in the previous cycle that the previous high was at the 61.8% mark, and as well as the high before that actually touched the 50% mark. So I think these two levels provide some good support. So when we drop down to the 50% level, I will be buying some of my favorite stocks. And if it goes even lower than that, then honestly, that's pretty sweet. And I'll be picking up a lot more stocks from there. Now looking at the chart a bit further, we can see that from the peak to the bottom here, we're only down about 3.85%. Honestly, that's not much of a drop. I think that we could see a correction of around 10%, which would bring us down to in between the 50 and 61% level. So you can see here it's around 9.5 and down here is at 11.33%. So I wouldn't be surprised if we see a market correction of around 10%. And that's honestly what I'm predicting for this cycle here. I may be wrong, but this is what my thesis is, and this is what I'm going to be sticking with for my trading going forwards. Now, for everyone who's invested in technology, this is the NASDAQ. So we're going to look at the NASDAQ and just see what these charting patterns show us. So from the bottom in March all the way to this high here, we can see it retrace back to the 23.6 level. This candle was right there, and then this candle just hovered between before it shot back up. And then it also came back down, touches 23.6% level, and shot back up to new all-time highs. So you can see there's a lot of support at this level here. Now doing a quick retracement on this small dip, we can see that it came back down to the 78.6% level, as well as in this week here, we can see it was around the 61.8% and shot up to new all-time highs after that. Now moving on to the next pattern at this low here to this high here, we have touched the 23.6% level and we actually dropped quite a bit below that. So the next level to watch for is the 38.2%. Honestly, I don't think there's much support there, so I'll probably come crashing down even further, maybe to the 50% level because we did see a candle here, which wicked down and almost touched this level here. So there might be a bit of support here, but I'm more interested in the 61.8% level. And we can see this was the previous all-time high here, and this one is roughly around that level as well. So I expect the NASDAQ probably to pull back to there. Now in terms of percentage points, let's just check out what that is. So we go from the top here to where we are currently, we're down about 8.3%. Now if we pull all the way back to the 61.8% level, we're dropping around 15%. So the previous drop here was actually a 12.8% drop. And it's funny, the chart can be fairly deceiving because the drop here versus the drop over here, if we're to do a 12% drop, it looks a lot more significant when we're at a higher level. And that's because this is a linear chart. Looking at this other small pullback we had, we can see the pullback was around close to 10%. So we're not quite yet at the 10% pullback mark for the NASDAQ. So this is another reason why I think that we have a bit more to go before we hit the bottom. The 10% mark would actually be right around the 38.2% level, just a little bit below that. So if you guys are, thinking you're fairly bullish on the market, then I would honestly wait for the 38.2% level before averaging into your stocks. So in summary, with all these charting patterns, I don't believe we're yet at the bottom of this correction. I don't think we're going to see like a 30% crash like we did back in 2020. This was roughly around a 32.67% or 76%. And if we look at the S&P 500, we dropped around 35.67%. I don't think we're going to see that dramatic of a drop, but I do expect somewhere between 10 to 15% for the SPY or the S&P 500. And for the NASDAQ, I expect maybe somewhere between 15 to 20%, just because there's more high growth names in there, and those are tech stocks, and tech stocks are quite hot right now. If you learned anything new from this video or found it useful, consider leaving a like down below. As well, if you want to know what I'm buying and selling in the stock market and when I'm doing that in real time, consider signing up for my Patreon group down below. I also have a free Discord group down there for all you like-minded Canadians who are interested in stock market investing. If you want to check out more stock-related videos, check these two out here on the screen. If you're there, I'll see you there. If not, keep up the grind and have a great day.